online at Metropol TVKE. We are live www.metropoltv.co.ke. Thank you very much for choosing to begin your day with us. We are looking back to 2021 and asking ourselves, how has the economy performed throughout that entire period? And we're looking at the key sectors and industries. And this morning, we take a look at the banking industry in Kenya on exactly how it has performed. Now, let's do a brief introduction. Overall, the banking industry in Kenya is governed by the Companies Act, the Banking Act, the Central Bank of Kenya Act, and the various prudential guidelines issued by the Central Bank of Kenya. Now, with those regulations in place, the banking industry has still had a massive contribution to the growth of Kenya's economy, besides challenges around it. Good. Now, this morning, I'm going to introduce a panel that is going to join us and take us through the general performance of the banking industry in 2021. And I tell you, it's a huge panel that is gearing up for an exciting conversation this morning. Let me first with the introduction. We are joined by Faith Atiti, who's a research assistant, NCBA Bank. Faith, good morning.
Good morning. Thank you for having me.
Fantastic. We are also happy to have you around as well. We do expect to be joined shortly by Abraham Mamudhogo, who is the CEO, Miradi Capital. As we wait for Abraham to come in, let me also go through part of that panel that we have this morning. But let me just go or take you through like this. Faith, let me start with you. Just quick introduction or sentiments on how you think that the banking industry has performed in 2021, just before I introduce the next panelist who is joining us this morning. General sentiments, just 15 seconds. How do you think the banking industry has fared on in 2021, Faith?
All right. Thank you again for having me. It's certainly been a fairly difficult period for all sectors. Certainly 2021 has been a better year coming off the pandemic. With the easing of mobility restrictions, we've seen activities recover across most sectors, and being at the center of it, you expect the banking sector will indeed benefit from the momentum. That said, I think even through the pandemic, the sector demonstrated remarkable resilience, wading through with limited shocks on balance sheet. Initially, we'd expected to see a market rise in non-performing loans, deterioration in quality of assets. But considering the write-backs we've seen through this year, it's indeed certain that the impact, the sector withered the pandemic much better than we'd initially anticipated. So we expect to see further gains into this year as economic activity recover. Then you'd expect more people to come to the banking sector for liquidity and capital. But we also are very alive to the fact that we indeed still have market challenges that we still have to confront, including just that levels of NPL. We still have the raging pandemic, which means the risk environment remains quite volatile, and to hold out capital in such environment, you still want to protect your capital. So any aggressive investments are not indeed expected. In fact, we still expect to see more investments towards the sovereign, more appetite for the sovereign than the private sector, until there's some level of certainty or some measures like what has been initiated with the credit guarantee to just cushion banks against extreme risk. If they have to, if they do materialize, then we could see activity pick up much faster. But nonetheless, I think we still should see pick up within the sector.
Pretty much. All right, joining us again just for quick introduction sentiments to this conversation. We're joined by Anne Wasera, who is an investment analyst, Saiton Investments. Anne, good morning, and we are happy to have you around. Anne, in just 15 seconds, what would you describe as the performance of the banking industry in 2021, Anne?
Thanks for having me today morning. I'm Anne from Saiton. So for the banks, we've seen an improved performance, just as Phil has indicated. we've seen their income grow as very high, especially given the waiver of the mobile fees transaction earlier this year. And we've seen, as much as the environment remains risky, we've seen their NPL ratio, the bank's NPL ratio or asset quality continue to improve, and we expect to see this in the near future should the effects of the pandemic continue to ease down.
Pretty much.
Thank you.
All right. Next up, just before we dive into that conversation, we also have George Manga, who is an economic analyst and managing partner at MG Kenya. George, happy to have you around, sir. Your introductory sentiments, the general performance of the banking industry 2021, especially after a tough 2020.
Elijah, I think the banking industry has performed, they have posted a very strong performance in 2021. If you look at their results for Q3 2021, most of them have registered between 30 to around, there's one that's realized even 1,026 percentage growth in their year-to-date profits for Q3. But just look at the industry in three tiers. The top tier banks have performed very well. Tier 2 banks have also performed quite well, but tier 3 banks still have not performed quite well. In fact, most of them have made losses for the third quarter 2021. So you must look at it vis-a-vis that. And then again, just to say, our economic growth for 2020 coming 2021, 2020 Kenyan economy grew by only 0.6%, but coming in 2021, I think we've seen quite some strong rebound, and we're expecting to grow by around 5.4%, which I think will be achievable by the end of this financial year. So, Elijah, in summary, I think the banks have been resilient, and that has been shown in their Q3 performance.
Yes. Pretty much. All right, let me introduce Arnold Nkisale, who's a microfinance banker, to the conversation as well. Arnold, good morning, sir. Let's get your introductory sentiments on the performance of the banking industry in 2021. Do you share the same sentiment that the CBK, who's the regulator of that industry, and the panelists that we've spoken to this morning about the resilience of that particular industry in 2021, Arnold?
Thank you so much, Simba. Thank you for having me. Yeah, I think I share the sentiments of my fellow panelists this morning. The banking industry has demonstrated a lot of resilience. Actually, we've seen a lot of growth as far as the balance sheets sizes are concerned, asset quality is concerned, because banks essentially adapted very quickly to the effects of COVID-19 and what happened in 2020. So I think in 2021, we saw a lot of resilience and adaptation. And as you mentioned, crucially, CBK played a part, particularly by holding the CBR rate at 7% throughout the year. It was very intentional and very conscious, just to try and ensure that access to credit, as far as the general economy is concerned, is viable. So yes, a lot of resilience has been shown. Again, George has mentioned something extremely important by looking at the layering of the banks. I think if you look at the general perspective, resilience has been shown. But if you look at the tier 2 and tier 3 banks, we still have a lot to do, because I think for them, it took a little bit longer to adapt, probably because of infrastructural issues, probably because of business models. But generally speaking, we've seen a lot of resilience as far as 2021 is concerned.
Pretty much. All right. In the studio, we are also joined by Abraham Mudhogo, who's a financial expert and CEO of Miradi Capital. Abraham, good morning. We are at that point where we're looking generally, or picking your first 15-second sentiments on the performance of the banking industry, especially after a tough 2021. The general feeling in the room already is that, well, this particular industry has been quite resilient to the effects of the coronavirus pandemic, and that would continue, especially into 2022. Do you share that particular sentiment?
For me, I look at it differently.
Yes.
The first thing, if you look at it, number one, there was a lot of write-backs.
Yes.
So that contributed heavily to their interest income.
Yes.
Number two, there was also a lot of push towards non-funded income, that
yes.
commissions and other things. So and then number three, banks, as much as they made a lot of money, they were very, very cautious. So because what they did, they were consolidating. They were lending to people, to existing customers and sectors that they were sure about.
Yes.
So going to the next year, are we going to be able to replicate what has happened? Maybe not, because whatever you could write back, you have written back. So now and then, this coming year is also starting with its own challenges.
Yes.
New variants. So it's the ones who will make more money are the ones who are able to completely transform their model.
Yes.
To away from what we were always used to, especially from non-funded, the non-funded income.
Yes.
So for me, yes, the resilience has been there because
Yes.
it's true they have survived it.
Yes.
But as to whether they'll continue making the kind of money they're making will depend on how well they can adapt and to a new model, to a model that adapts the new environment.
Pretty much. All right, let's dive into it then this morning. And I would like to open officially this discussion with our Faith Atiti, who's a senior research economist at our NCBA Bank. Fantastic. Let's look at that data that we have for you this morning. And there's going to be a flurry of it, really, because there are a lot of conversation points that we can pick this morning from this particular industry. And if you look at banking sector, total assets, you will see that indeed the general trend from 2020 to 2021 up to where we are, that these have been looking up. But then there's a caveat to that we're going to introduce into this conversation, because the biggest contributor is going to be revealed in this conversation as well. All right, let's move into the second one as well this morning. When you look at banking sector total liabilities, you will say that indeed we're going to close 2020 without having dropped just a little bit, because we do know when we're talking about non-performing loans, we do know that did jump 14.6% in 2020, and then we had it come back to around 14% again in 2021. We're going to talk about that as well this morning. Let's move on to the next one as well. When we're talking about banking sector total liquidity ratio, the average, as we do know, is that in 2020 we're actually talking about 20% more average from where it actually needs to be. So the banks right now in 2021 quite liquid. That has been the conversation around the liquidity in the banks right now. All right, Faith, let's jump into it then. This growth that we are talking about, what we do know is that what was headlining the banking industry in 2020 was mass provisioning for either non-performing loans or bad loans as well. So when we look at this jump in 2021, should we look at it single-handedly or separate it from what we like to call a rebound from the slump that we saw in 2020? Which therefore makes me ask you the question, should we wait a little bit longer before we say, well, the banking sector or the banking industry has been quite resilient? Should we separate what a generic growth is from a rebound from 2020, Faith?
Thank you, and that is certainly a good question. So should we say the banking sector was resilient despite the numbers as you've outlined? Certainly, yes. Of course, when you're looking at resilience, you look at it a whole more broadly than just looking at the income per se.
Yes.
First, the sheer fact that we didn't have many banks, if any at all, are reporting losses through the period, despite that heavy provision into 2020 just underscores that level of resilience. Yes, we had provision sort of distorting the way you literally should look at bank balance sheet at the moment. But this was, of course, a global phenomena. The measures initiated to make, remember, in any economy, the banks are the center of it. If you remember the global financial crisis, it started with the financial sectors. Most crises we've seen in the past, if they are not originating from the financial sector, they tend to be exaggerated or aggravated by shocks to the financial sector. So it was imperative that the government and the central bank respond the way they did.
Yes.
Coming into 2021, certainly we've seen this right back, which just suggests that risk as had been envisioned at the onset of the pandemic did not crystallize as was initially expected. Yes, most banks, it's prudent that when faced with risk as a bank, you do make provisions. You gradually make provisions so you're not hit immediately. And of course, we've seen a lot more stringency in the way we do provisions with the adoption of IFRS 9 or the more latter accounting measures, Basel 2 or is it 3? The accountants on call maybe could have more insight on that. So should we strip out this provision to just outline the level of resilience?
Yes.
Certainly, yes. There is that aspect that you need to sort of sieve out when you're looking at it, just to underscore how strong the banks are. But even if you had to sieve out that, you'll still have at worst profits declining rather than outright losses for the banking sector,
yes.
which still underlines just the level of resilience for the sector.
Yes, pretty much. All right. Now, George, I just want to bring you in as well. Just quick sentiments on that as well. I mean, when we're talking about this growth, George, in a 2020 to where we are in a 2021, I mean, yes, you call it resilient, going by the absolute numbers that we're looking at, but then should we just call it a rebound and then separate 2020 from 2021, George?
Elijah, if you look at the top banks, and
yes.
I want to pick just a few, mix of KCB, 25.2 billion profit in 2021, which is NBK, which is subsidiary of KCB now, posted 1.1 billion profit. That's the
yes.
PBT from 87 million last year. That's 11.26% growth. Equity posted 26.8 billion vis-a-vis 15 billion last year, which is almost 79% growth.
Yes.
And then lastly, Cooperative Bank posted 20 billion PBT against 10.1 billion last year, which is 19% growth.
Yes.
So if you look at those metrics, Elijah, vis-a-vis what we posted last year, and then vis-a-vis what we posted in 2019, then you realize if you look at 2019 vis-a-vis 2021, there's a slight growth. But if you look at 2020 vis-a-vis what we have posted in 2021, then you realize that there are very huge jumps. One of the main reasons to this is that there was heavy provisioning, just as my fellow panelists has put it, in 2020. And therefore, coming from that level to where they are to date, there is that huge jump in their profitability. But Elijah, there is, as I said earlier, when you layer these banks in tier 1, tier 2, and tier 3, tier 3 banks didn't fare very well. In fact, currently we have problems with Spire Bank that I think central bank has a very big problem with because of liquidity challenges. The same to the other tier 3 banks that didn't post very strong performance in quarter 3. The likes of UBA, the likes of EcoBank, and so forth. But that notwithstanding, if you look at the overall industry, then we can say with certainty that the industry has reported very strong performance in 2021 vis-a-vis 2020. But that underscores also the resilience of the Kenyan economy.
Yes.
If you look at the Kenyan economy vis-a-vis our peers in the region and even the global economy, that is sub-Saharan Africa, the average growth in 2021 was negative 1.8%. Yet Kenya reported a growth of 0.6% in 2020. And then come 2021, the average growth in the sub-Saharan Africa, I think, is forecasted around 3.4, vis-a-vis 5.4 in 2021 for Kenya. So the banking sector now mirrors what our general economy looks like. If you look at it in terms of GDP growth, vis-a-vis the global economy, and then vis-a-vis our peers. So in a nutshell, Elijah, I think we expect the banking sector to perform even better going into Q4 of this year,
yes.
and then going into maybe Q1 and Q2 of next year. We don't know how the elections will look like next year, but we expect if things are the way they are to date, then the banking sector will remain strong. Then lastly, Elijah, let me just put this point. There were measures that central bank put in very clearly as the pandemic was starting, and I think that cushioned the banks very much to enable them circumvent or enable them go through the pandemic. One of them was to lower the CBR rate
yes.
to 4.2%. what this in a sense did is to push in liquidity back to the banking industry, so that at least with the pandemic they could have that leverage to be able to invest in other assets other than loanable funds. And that tells you, if you look at the CBK metrics, almost 76% of the liquidity in the market went either into treasury bills or treasury bonds. And you saw those are very secure assets, so to speak. So that is one of the areas that I think gave a lot of leverage in the banking industry. Two, there's the lengthening of the repurchase agreements, which was pushed from 28 days to 91 days.
Yes.
That also pushed a lot of liquidity in the market. And then, of course, the restructuring, the allowance for restructuring that central bank gave to the bank, so that classification of assets was relaxed, so that if a customer was not able to pay last year for maybe 1, 2, or 3 months, then they were not classified as bad debt %, but they were allowed to restructure those facilities. So I think those measures have played a big role in what we currently see in the performance of the industry.
Yes.
Elijah.
Pretty much. And let me jump to you as well before I jump to Abraham and Arnold this morning as well. And let me just do a start here, especially when we compare where we are from Q2 of 2020, especially to Q2 of 2021, where banks' assets, they jumped by 12.4% from where they were in Q2 of 2020. I mean, they jumped to around 5.679 billion. That's a big jump as well. Again, when we look at loans and advances and securities, they accounted out of those assets that we're talking about, and they accounted for 50%, that is loans, and 30% of net assets in December 2020, compared to now a jump again when you look at Q2 of 2021 of 54.8% and 31% in June 2021. Those are loans and government securities. So loans accounted for 54.8% and 31% of government securities to those banks' assets in June 2021. So, and indeed, you could say that now us saying that this could be separated from the growth in 2020 is clear, because you can actually see banks started lending heavily as we got into 2021, because they were sort of coy to lending in 2020, and which is why I'm still asking, can we separate that growth from 2020 to 2021 and say, hold on, this could be a rebound. Let's compare 2021 and 2022.
Thank you for that question, and I really do agree.
Yes.
First, we have to separate, because remember, 2020, the whole from March to like December, we had the effects of COVID,
Yes.
and banks didn't want to lend out to businesses or customers or even the private sector, given the credit risk that they perceive when lending out to these
Yes.
customers. But you see, in 2021, when the loan window, moratorium window expired, the growth, as we've seen, the GDP started improving. So businesses started going back to their normal activities. And then you'll see maybe from around March to, let me say, up to September, we've seen a lot of improved business environment. We've seen now banks, as you've seen in the data, they started lending out now more loans to businesses and to customers than investing in government securities. Last year, yes, they did invest in government securities heavily, so that they can just reduce the risk that is associated with lending out to customers.
Yes.
But this year, we've seen the yield curve decline. So you see, even for banks, they are always after the interest income. So you'll see they'll lend out more loans to customers and portion a bit to government securities, as much as there is low yields. So going into 2022, given that 2021 environment will trickle down to 2022, I believe we should, and actually we can compare 2022 and 2021, because 2020 is more of an outlier. It's giving a lot of low numbers, given that they had to provision, they had to actually reduce their strategy. So 2020 is more of an outlier, and that's why you'll see for 2021 their income is increasing so much, just because of the low base effect. You see, in 2020, let's say their income was for a certain bank, let's say it was around 20 billion, but for this year you'll see around 50 billion. But it's just because they had to provision a lot last year. But for this year and next year, we've seen reduced provisioning levels, and we expect it to trickle down to next year. Even the
Yes.
non-performing loans, as much as they were a huge percent last year, this
Yes.
year, given now the improving business conditions, it's going to reduce or just normalize and go back to pre-pandemic levels. But a disclaimer is, with the new Omicron variant, we don't know how it will affect. Maybe its effects will be more than the COVID-19.
Yes.
Maybe banks will have to provision more. They'll have to put in more strict measures just to ensure they survive again. Because in 2020 it was also a survival for banks, as we've seen. Tier 1 banks were able to survive. Other banks such as HF, they've been continuing to record losses over the quarters, over the years. So with this Omicron variant, if it does affect the banking sector like we saw in 2021, banks will have to do more. They'll have even to put up more stringent measures, especially into lending out to businesses. Again, we have election, and next year has a lot of uncertainty. We have election, and we don't know how these elections are going to affect banks lending out to customers.
Yes.
So for now, it's more of a wait and see. But yes, we can compare 2022 and 2021 with the disclaimer that 2020 was more of an outlier.
Pretty much. All right, Abraham, let me cross over to you now. And I would like to start your conversation like this. I mean, for us to look at how the banks are performed, then we got to look at that non-performing loan ratio within the industry. What we do know that NPLs increased to 14.1 in December of 2020, 14.6 in March 2021. Now they've eased back to around 14% in June 2021. Abraham, hold on. This 14% number, last year, when we got into the coronavirus pandemic, they said this 14% will not be an accurate measure of the NPLs within the economy. They said, now what you gotta do, all the loans that have been restructured, include that in the NPL ratio, so that now we get the exact figure, because we do know banks like Equity actually did extend that moratorium up to around 2023 as well. So you just can't call that performing loans, especially when they have been restructured as well. But Abraham, going by this as well, I mean, we've been stuck there. You say exactly what the CBK said last year, that they were afraid it might get to 16-17%, but it did not. Is this a proper indication then that, well, they were quite resilient?
You see, you put it very well. I think we are comparing apples and oranges.
Yes.
Because when they're competing for 14% during the pandemic period,
yes,
a lot of metrics were changed. Because even the definition of what is bad and what is good changed. It changed and it changed significantly.
Yes.
So what was 14% then is not what is 14% now.
Yes.
So even to compare those figures actually is to compare two completely different things.
Yes.
What is important is how do we compute what is non-performing? Have we reverted back to the prudential guidelines of the 5 categories of normal, or substandard and loss, or are we still in that regime? Because what is critical here is quality of assets.
Yes.
You see, you're talking about how assets of the banks have gone up. That is quantity, but what is the quality of that asset? So it's very, very important that how we measure the quality is what is critical, and how we arrive at that number.
Yes.
So that way we are able to and use the same measures over time. So that we're able to compare that number.
Yes.
Otherwise, if every time something happens, we change the metrics, then those numbers cannot be compared, because they have to be looked at the context, on the context of under which they were put together, and the context prevailing at that time.
Yes,
yeah,
pretty much. And I'll clear this conversation for the resilience of the banking industry in a 2021. Just before we talk about exactly what this NPL ratio means, Arnold, yes, you said they have been resilient, but then is this a confirmation that indeed, because the fear was that in 2020, when everybody was crying about how the economy has been affected heavily by the pandemic, we're still stuck at 14.1%. In fact, the worst NPL ratio, according to the CBK, was in March 2021, when we jumped to 14.6% before we came back to 14%, the one that we actually saw in a 2020. Is that enough reason for us, Arnold, to say, well, but you see, they did not change that much, so it was quite resilient?
Yeah, thank you so much. I think several things need to be factored in.
Yes.
I think a longer analysis. It would be prudent to do a longer analysis to quantify the resilience. Yes, we've seen resilience in 2021, but it would be prudent to have a longer analysis, probably look at what will happen in 2022, as alluded to by Anne, as far as some of the changes we're expecting to see with elections coming in, with a probable issues to do with the Omicron virus. However,
Yes.
from my point of view, I look at it like this. 2020 was a reset year. Essentially, everything was being reset. Financial institutions pressed the reset button, but also businesses and government entities had to press the reset button.
Yes.
So what we're seeing in 2021, several things. Banks did several things. Number one, banks did a lot of collections, resilience, stepped up collections. So if you look at what happened in 2020, there are several phases. Number one, there was an initial restructuring of facilities with the thinking that COVID-19 would probably be a 3-month or 6-month kind of event. Unfortunately, that did not happen. So it simply meant that the restructures had to go on longer and certain provisions had to be put, more provisions had to be put. So that simply meant we saw a very massive dip as far as bank revenues are concerned.
Yes.
Now in 2021, we've seen a lot of recovery. There's a lot of inoculation going on, reopening of the economy, and also intervention from international bodies. We've seen a lot of interventions by the IMF, World Bank, and also institutions like the European Investment Bank, which is has done a lot of interventions with the likes of Coop Bank, just to try and support the MSMEs and try to inject liquidity into the economy, and also try to force the hand of some of these banks to actually lend to clients and not necessarily just lend to the government.
Yes.
Through basically purchase of government securities. So that aspect of resilience, yes, if you look at it from a general perspective, I would definitely agree with all of my panelists that we've seen a lot of resilience. But if you strip it, if you strip down to various factors, various interventions, various indicators, then it would be prudent probably to have a longer analysis of what will happen in 2022.
Yes.
Traditionally, we've seen capital flight during an election year, especially in Africa, because guys normally tend to have a wait and see approach as how things will pan out. Again, we also see low government spending during election year, particularly because of trying to either, you'll see procuring entities either trying to complete whatever activities that they have, or you will see a lot of quote unquote campaign funds being mobilized. So again, if you factor in these raw economic activities from a microfinance perspective, then you'll be able to gauge exactly what will happen in 2022. So a longer analysis would be prudent to do a longer analysis, but generally speaking, resilience, you can say that the financial institution or the banking sector has demonstrated resilience.
Yes.
In 2021.
Pretty much. All right. Now let's go
Elijah,
on a
if I may
break.
just add-
Just hold on. Let's go on a break like this. I just want us to come back immediately and talk about that once we come from this slight break here. But I want us to go on a break like this. I'm going to pick just 5-second responses from all of you because I want to throw a spanner to that performance just before we take that break. Now, this is it. 9 banks, that is in tier 1, accounted for 86.9% of total industry profit before tax in 2020, with the remainder, now wait for it, 30 of those banks as well in the other tiers accounting for just 13.1% of that profit before tax. Now, let me throw another spanner into that. If you look at exactly how interest rates have been since 2020, you can see that the CBK has tried just to come in and throw just a cushion to the economy in that area. But around that area, what we've seen is that majority of this growth that we're talking about from these banks has not been in the mass market. Because as of June 2021, all the banks in the country, in terms of liquid assets, Treasury bonds and bills accounted for 71.1% of what they held as liquid assets. Now, let me go back to the other one because we're going to talk about that type of growth then once we come from this break. Let me start with your Faith Atiti, Senior Research Economist and CBA Bank. that only 9 banks accounted for 86.9% of the profit before tax, and at 2020 with 30 of them just taking 13.1%. Faith, in just 5 seconds, is it time for us to really go back and say, well, we need to debunk Kenya? 5 seconds, Faith.
Well, thank you, and I think there's been very deliberate effort towards consolidation within the sector,
yes.
Where you put more banks together, build scale, which of course has implication on pricing and competition, of course, all for the better of the market.
Yes.
But whether that will be achieved any soon remains as good as, your guess and mine.
Fantastic.
It's a free market. So
fantastic. We're going to come and talk about that once we come back. Let me go to George Munk, economic analyst and managing director, AMG, managing partner, AMG Kenya. George, that only 9 banks accounted for 86.9% of the profit before tax in 2020, a time when the Kenyan banks were really feeling the heat of the coronavirus pandemic, with 30 taking 13.1%. George, time for us to bring debunking Kenya to the fore. And Mike, I miss your mic, George.
Sorry, Elijah. I'm saying if you look at the stress testing report,
yes,
from Central Bank of Kenya, that is for Q2.
Yes,
you realize that several sectors took a hit from the economy. The reason why the bigger banks fared better than the smaller banks.
Yes,
the bigger banks have a fairly spread portfolio. You'll find them in agriculture, you'll find them in manufacturing, you'll find them in ICT. But the smaller banks, their portfolio is quite small. You'll find them maybe just in trading and maybe in manufacturing. That is why when a shocker like COVID-19 came,
yes,
then the bigger banks are likely to perform better than the smaller banks. And then again, it boils down to core capital.
Yes,
Most
George,
of the bigger
George, we have
banks
5 seconds. Remember, we're going to take a break. I want to pick those points once we come back. Just 5 seconds.
Yes,
time for debunking Kenya.
I think that is the way to go. That's the direction that central bank is trying to
yes,
push the industry to. We need to consolidate some of these banks to more bigger and more stable entities.
Pretty much. I want us to talk about that once we come from this break. Let me come back to the studio. Abraham, that's a huge disparity. Time to debunk Kenya?
Yes, I think it's a capital game. So the mighty will survive, and,
yes,
and the weak may not.
Pretty much.
Yeah.
All right. Let me go to Anna. Anna, huge disparity. Just 9 of the tier 1 banks controlling 86.9% of all the profits before tax in a 2020. Time for debunking Kenya conversation being more serious.
Yeah, I believe a lot more conversation needs to be done on consolidation, given that we remain overbanked.
Pretty much. I want us to talk about that once we come back. Let me cross over to Arnold Gasale before we take this break. Arnold, big disparity in that. 86.9% just for 9 banks, and the other 30 are scrambling for 13.1%. Arnold, debunk Kenya or
not? Inorganic growth, as my fellow panelists have mentioned, may be necessary.
Yes.
Through consolidation and mergers.
Yes.
And it's a conversation which was there from increasing the core capital from 1 billion to about 5 billion about 5 years ago. And I think it was shelved. It may need to be revisited.
Pretty much. So once we come back, let's talk about this growth then that we're talking about, because if 71.1% of liquid assets that banks held as of June 2021 was in treasury bills and bonds, should we question this growth? Because the same period we've had the CBK really lowering interest rates at a time when public debt has been growing as well. Did they give banks an avenue for growth? Should we then question that? Once we come back here on a Metropol television, you are still watching Business AM.